And here's your closing bet.
All right, and stocks ending the day in the green. We got the Dow 1.58 percentage points, S&P 500 up 1.43%, and the NASDAQ, we'll call it a laggard, they're up 1.26%, but everything still strongly in the green. We're taking a look at that inflation data looming tomorrow and a pending Fed decision this week. Where do the markets go from here? For a closer look, we're going to bring in U.S. Bank Senior Vice President Lisa Erickson and Acorns Chief Investment Officer Seth Wunder. Seth, let me pose this to you first. In terms of that inflation reading we're supposed to get tomorrow, and then how are you viewing the potentiality, especially with respect to the fact that the Fed will get to consider that as well in its 2 days decision, policy-making decision, which they announce on Wednesday?
Yeah, I mean, the broader inputs to inflation are slowing quite considerably. I mean, if you look at unleaded gasoline across the country, it's actually flat since the beginning of the year, and oil year to date is now down. Whether that shows up in any one data point in government metrics and so forth will be a little harder to predict exactly. But I mean, you saw the Fed governors earlier in the month talk about a slowing rate of increases and so forth. I mean, they understand that the economy is slowing quite precipitously. So the trend is a slowing of inflation for sure. Tomorrow's data point, we'll see give and take.
Lisa, what do you think? Do you agree?
We do expect inflation to continue to come down. It may have some fits and starts to it, but what we see overall in the data is both on the goods and services side of the economy, some slowing. So I think really the key question is not necessarily the direction, but the magnitude and the speed at which inflation continues to come down. That's really the big question for the markets. Obviously, we got some very positive sentiment today as we saw some of those inflation expectations from the New York Fed continue to come down. But the central bank is wanting to see that continue to come through in the data. So it'll be great if we do get a letdown in the pace of inflation in tomorrow's CPI point, but we're going to want to continue again to watch how quickly that continues to evolve through the year.
Hey, Lisa, Pross here. Just want to follow up on your question there. Tomorrow, big print tomorrow, CPI, also the Fed meeting starting tomorrow. I'm kind of curious today. We saw a big move in stocks, but also the volatility sort of picking up too. I had a big move in the VIX. What do you think? What do you think is behind that exactly?
Well, investors are trying to be more positive, as we've seen over the last few weeks, but there is a lot of uncertainty over what the outcomes will be. Again, we've started to see some decline in the rate of inflation in various measures, but again, people are not sure how sustained that will be. And we did get a negative surprise from PPI last week on the input side of the price pressure. So I think what you're seeing with that jump in the VIX is, again, people are hoping that we're going to get some more positive news, but just the level of uncertainty is causing that volatility to rise.
And Seth, I want to ask you about this Nick Timiraos article that appeared in the Journal this morning, the also known as the Fed Whisperer, putting it out there quite plainly that even if we get a recession next year, the Fed's probably not going to pivot right away. I'm wondering how you square that with your notes to us in which you're saying that a Goldilocks scenario of sustained growth, modest rise of unemployment, and cooling inflation are still on the table. Are these just realms of potentialities here? What's your base case?
Well, I think those are actually quite consistent, right? So, as the economy cools, to the degree that it doesn't accelerate to the downside, we could actually have a jobs market that stays fairly robust. But the Fed, doesn't have to keep raising rates if inflation cools, and they also don't have to necessarily ease to the degree that the economic slowdown is modest. And that the employment picture doesn't alter all that dramatically. So, risk assets would adjust to that Goldilocks backdrop. The reality is I think what the Fed wants to do is probably pause through the first half of next year, assess where we're at, give time for these rate increases to continue to flow through, particularly in the housing market and consumer spending and so forth. And then we'll go from there. So I actually think that narrative of Fed pause and potential Goldilocks is a continuation of the same storyline.
Seth, when it comes to Fed policy, I guess, what do you think has already been priced into the market? It sounds like 50 basis points on Wednesday is the most likely scenario. That's what traders are mostly anticipating. But looking further out, how much of that has already been accounted for?
Oh, I think all of it. To the degree that the Fed gets themselves into a position where, I mean, maybe there's another 25 or 50 basis points behind that, and it trickles over the first half of next year. I think that's pretty much in the market. I mean, if you look at like capital flows, where volatility was all this year, and how people are invested and so forth, the sentiment has been horrific, except for the last, let's say 45 days. So whether it's forward curves and so forth, the market's discounted a lot. It's not dissimilar than if you go back to the early 80s. The reason why the market was up so dramatically after Volcker pivoted was because the fear factor of not having 2 points makes a line is sometimes stymieing to people. I wouldn't say it's as extreme today, but it certainly you see it across the board. So to the degree that we get ourselves into a predictable environment of where rates can normalize here, I think the market has overly discounted some of the worser case, more difficult scenarios.
Hey, Lisa, so if you think that, like Seth's saying, the rates kind of will normalize soon, what are you sort of looking at in terms of plays for investors at this point?
Well, right now we are uncertain again how quickly the Fed is going to pause and then pivot. So because of that, we are more cautious overall on more risk-on assets like U.S. equities. So we are really advising our clients to relatively emphasize bonds and things like real assets, both including listed real estate and listed global infrastructure. And the reason why is if you look at those various asset classes, they do have relatively high levels of income, and that can be really a nice buffer in a more volatile environment and an environment where stocks are certainly facing headwinds, again, just because of the tightening monetary policy.
All right, Lisa Erickson, Seth Wunder, always great to have you. Thanks so much for joining us this afternoon.